morning and good afternoon. I'm Alan Pontius. I'm the Managing Director for Marcus & Millichap's Office and Industrial Division. I'd like to welcome you today on behalf of myself, but certainly on behalf also of, to my right, Bill Hughes, the head of Marcus & Millichap Capital Corporation, and to Bill's right, Hessam Nadji, head of research for Marcus & Millichap. Welcome to our session today. What we're going to do today, many of you are joining us again and have been with us on our prior sessions. So what we'll be doing again is taking you through a quick look at the economic landscape and try and tie in some of the factors, the situation, the issues of the economy and how those relate to office and industrial investment. Bill will then talk a little bit about the capital markets, what we consider to be a favorable and expanding debt environment. I will conclude the session today by giving you a brief overview of the office and industrial market from a trade point of view, investment transactional point of view, and with the time that we have left, what we will do is offer opportunity to you to ask us questions, and we'll get back directly to those questions. I should point out that you have an opportunity to submit questions at any point in time during the broadcast. So if you'll note your submit questions box on your screen, please, again, take the opportunity at any point in time that you would like to submit a question. Hessam will be capturing those questions as they come in, and we will do our very best to get to each of them. Those questions that we don't get to during the broadcast today, we will follow up directly on all of them. Just a couple of points, a couple of items right before we get started to try and make this as good a session as possible for you. First is we'll be advancing the slides from here, so you won't have to do anything from your end. However, should the slides lock up or should you have any kind of technical problem, the F5 key should allow you to refresh your screen and hopefully clear up any problem that you have at that point. I've already talked to you about submitting questions, so really we're ready to begin. Hessam?
Good morning and good afternoon, everybody. It's a pleasure to be part of this program. Thank you, Al. My job today is to talk about the economy and office and industrial fundamentals. So to start with, I think it's important to do a bit of a look back and kind of update the perspective on what's happening with the economy. If you've been with us, last time we had this session, I talked about the tug-of-war that was going on between the positive developments in the economy and the headwinds that we continued to face. At the time, the U.S. downgrade of the debt was still relatively fresh. There was a lot of concerns in the marketplace of a double-dip recession and what the downgrade would mean to the capital markets. Our position was that the economy would endure, the recovery would endure through this turmoil, which we experienced in the latter part of 2011, and that we would not experience a double-dip recession. In fact, that turned out to be the case, and going into 2012, some of the numbers began to substantially beat expectations. So there was a lot of enthusiasm that now the recovery will even gain more traction. Just as we didn't really buy into the very negative sentiment at the time when the debt downgrade occurred, we also were cautious coming into 2012 regarding maybe the over-enthusiasm for just how much more rapidly the economy could grow. And the bottom line is that I still believe that the balance is very much of a push and pull between the headwinds because of the severity of the downturn we experienced a few years ago and the global nature of it. If you think about some of these headwinds, such as what's happening in Europe, the political logjam here in the U.S., the turmoil in the Middle East, and energy prices, those are serious issues that in one shape or another are going to pull back our growth over the next few years and have a bit of an anchor effect onto the momentum of the economy. The U.S. housing market, we received some data just this morning that home prices still are not getting much traction, and that's an important part of the consumer side of the equation. Having said all that, and being very mindful of these serious headwinds, we have to take note on the natural and what appears to be organic development of a lot of positive forces in the U.S. economy. And the major reasons we did not believe that the economy would enter into a double-dip recession were two or three very, very important drivers. One, retail sales, which now are 10% above the 2007 pre-recession peak. That accounts for 70% of the U.S. economic activity. So the consumer, despite all the headwinds and despite all the challenges, has performed much better than expected. Private sector hiring of 2.1 million jobs just in the last 12 months. Not very exciting, but nevertheless pretty consistent, and I'll talk more about that in a moment. Worker productivity having been squeezed to a level that employers have no choice but to bring back workers at a time when corporate profits are now 20% above the prior peak. Exports are growing at a rapid pace and account for a large portion of our economy. And most of the indicators, such as the weekly unemployment claims, really indicate a continuation of a positive job environment, although we're going to have some disappointments, as we did last month, and it's going to remain a relatively volatile and choppy kind of a recovery pattern. Nevertheless, we think 2012 will be a continuation of the recovery, and 2013 should show a little bit more momentum. Let me explain some of the reasons why we have updated this conclusion. Probably the most important one is the broad-based nature of the job growth we've seen over the past 12 months. The 2.1 million private sector jobs I talked about are very well distributed through various sectors of the economy, with professional and business services, a very important category for office use, being the lead generator of jobs of over 500 close to 600,000 jobs. Education and healthcare, it's 464,000 jobs. It's a very important portion of our job creation, with relatively healthy wage also in that sector. Leisure and hospitality, adding a lot of jobs. Trade, transportation, utilities, this is an indication of the strength of the industrial market, over 300,000 jobs, and even manufacturing at over 200,000 jobs. This is a direct link to our exports, which, as you saw from the prior slide, is growing at a very nice clip and accounts for 13% of our total economic output, at a time when for sale housing accounts for just a little over 2% of our economic output. And this very positive component of the economy doesn't get much of the headlines versus, let's say, housing or other seemingly negative parts of what we're challenged with. So the broad nature of this recovery gives us hope that it should endure through the headwinds and an election year at a time of continuing uncertainty around the world. Government jobs are still in the negative. If you've been monitoring any of our reports over the past couple of years, you'll see that the losses of government jobs have really tapered off. So that's another piece of very, very good news. Most of you are very interested to understand what's happening among different metros, and the interesting patterns that have evolved are shown here on the metros on the left, with the highest degree of job growth over the past 12 months versus the metros that are lagging on the right. One thing I should mention was that there was a major revision, as there usually is in March, of metro-level jobs. And so many markets that seem to have been asleep actually were not quite as bad as initially reported and came back to life with much more positive numbers. But the theme of the metro-level economic recovery is energy, education, high-tech, and trade. Those types of metros with a lot of reliance on those particular sectors seem to be leading the job growth. So you can see here on the chart, for example, Dallas and Houston are benefiting, of course, from the energy markets in many ways, but those markets have also diversified quite a bit. New York is another market that has continued to perform above expectation. And in more recent months, we've seen markets like Atlanta, Chicago join the ranking of higher absolute job creating markets. On the right, some of the themes still have to do with the lack of drivers. We've seen some of the Midwest markets that are still not really benefiting from the manufacturing resurgence that we're talking about, or the exports. And of course, then there's the lingering effects of the housing crisis. For example, you would expect Florida to be adding more jobs, even though jobs have been positive in Florida for some time. They're not among the job leaders yet, and I think 2013 really will be the year for Florida. So the housing crisis is still having a lingering effect on a lot of metros. When it comes to analyzing and forecasting what's happening with office and industrial performance and investment strategies, I think one of the important things is to really look at the details of where the jobs are coming from. What's interesting on this chart is our analysis of the past 18 months and showing which size firms or what types of firms are leading the job creation as measured in their size. The thing that we're looking for here is that the very small 1 to 10 person companies and 10 to 50 employee companies join the recovery and broaden the demand for office space. So far, as you can clearly see from this analysis, larger corporations have dominated the job growth, even on the profit recovery, because of their favorable access to capital, because of the fact that cost-cutting measures really were the driver of those profit improvements, and the multinational nature of the companies that are leading this recovery has really created more of a lopsided situation. And what we want to look for is a pattern of broadening. The good news is small companies have really pared back their losses. You can see the 10 to 50 employee companies now in the positive territory. And we expect this to continue to show a favorable pattern, and it's an important one to watch. It directly correlates with what is happening with the vacancy recovery we've seen in the office market in the Class A sector versus the Class B and C sector. First of all, I must say that the recovery in the office market has been lagging. Even though you saw some of those very, very strong job numbers in professional and business services, that is not translating to very strong absorption numbers. Even though absorption has now been positive for 5 consecutive quarters, was positive again in the first quarter of this year, the numbers are anemic. The reason for that is because companies had so much excess space, they had to burn through that first. We believe a lot of that burn off has occurred. So by middle of 2012, later in 2012, there should be a tighter correlation between a job added and space demand because of that burn off. Secondarily, companies are generally still very conservative coming out of the recession, especially those mid-sized to smaller companies we've talked about, trailing in the larger companies who are now consuming the Class A space, who are taking advantage of lowered lease rates and moving to more quality, higher quality space, are not really creating the backfill that normally would come in the form of a Class B and C, lower quality, maybe a little bit older, lower cost space that most startups and smaller to mid-sized companies consume during their expansion. So the good news is that the worst of it is clearly over. We are on a sustainable track of recovery, but it's going to be a gradual one. And I think in 2013 is when we're going to see the momentum really turn. Now, I'm not going to leave this slide until I mention a very important trend on what is shown here, and that is construction. On the supply side of the equation, we had the benefit of not overbuilding before the downturn, unlike many past cycles, even though, as you can see, the construction numbers increased in 06, 07, 08, compared to historical averages where, for example, in the 80s, we added 6% of inventory to the marketplace. In the 2000s, we were averaging around 1.7% of stock through new construction. Now we're averaging less than half of 1%. So the amount of new construction that is coming into the marketplace, being as minimal as it is a major factor as to why, in really the latter part of 12, 13, and moving forward, the recovery in the office market should pick up momentum. On the industrial side of the equation, there's been more of a rapid recovery, mainly because industrial demand moves much closer with the overall economic activity. You can see that the construction patterns here on the industrial side were not quite as muted as they were in the office side. We were overbuilding in many ways before the downturn came. Construction came to a virtual shutdown. Demand came back along with the economy, and therefore the trend on vacancy, again confirmed through the first quarter numbers of 2012, is more robust with vacancies coming down much quicker than the office market. This graph gives you an illustration of the correlation between industrial demand versus the GDP, which is our gross domestic product, a measurement of our overall economic output, as well as manufacturing output. There is such a tight correlation that, assuming that the recovery will continue at a modest 2.5% to 3% rate, which is what we expect for 12 and 13, the industrial recovery should continue as we move forward. One of the most frequently asked questions is how do the markets basically shape out in terms of vacancies and absorption and recovery. So we have the latest and greatest first quarter 2012 ranking of office vacancies with the lower vacancy markets on the left and the higher vacancy markets on the right. And what's really interesting here is the differences between some of the supply-constrained markets that have seen demand come back quicker than expected, for example, New York, Washington, D.C., which is not a surprise in terms of its placement on the lower vacancy markets, and even markets like Boston, Philadelphia, or San Francisco that have traditionally been lower vacancy markets. But what's interesting is the demand resurgence in markets like Houston, demand resurgence in specific sectors such as social media, which is impacting San Francisco and some of the other markets, really now coupling with the supply-constrained nature and supporting these markets in their position on the lower vacancy chart. On the higher vacancy markets, the story is very similar to the past trends that we've seen in terms of overbuilding and markets that just lack the recovery drivers where we haven't seen much of an improvement in vacancy yet. But one thing that Al will talk about a little bit later is how some of those lagging markets are now showing signs of life, and they might pose a contrarian view on where to invest. On the industrial side, of course, the supply-constrained nature of a lot of the markets on the left is the reason why they qualify to be on the left. There's been a lot of markets that haven't necessarily had a lot of resurgence in demand, but they just didn't overbuild. Therefore, they're still benefiting from lower vacancy numbers. Some of the higher vacancy numbers that may make one want to shy away are now showing robust demand. Some of those laggards that are now joining the recovery may be interesting markets to take a look at, and a lot of those are featured on the right side of this graphic. But when it comes to the industrial marketplace, of course, the most important thing is the port, gateways, and what's happening with trade. And trade, of course, as I mentioned earlier, is one of the bright spots in the economy. And with that, I'll turn the session back over to you, Al.
Hessam, thank you. Right now, we're going to move the slide advancer over to Bill. Bill, if you'd walk us through the capital markets, please.
Thanks, Al, and thanks, Hessam. You know, Hessam shared a lot of information with us, and like Hessam, I'm going to take a step back for a few minutes here so that we can talk about really what's been going on in the last 6 months. We'll look at sort of where that was. We'll then take a look at interest rates in general, maybe talk a little bit about their current stability, and then move into what potentially could be a little bit more volatility moving forward. And then finally, we'll give you a little bit of a outlook in terms of where we think certainly the marketplace is going to go. Deals are clearly getting done today on larger primary markets. Smaller markets are also starting to take hold here, and that's been a very positive for us over the last 6 months. Best of class assets to lesser quality assets are clearly getting financed today along the entire capital stack. The market remains spotty, however, for smaller transactional properties in tertiary markets, something that we're still dealing with, although the banks have certainly made a big push into those markets and have certainly helped us out there. Debt service coverage in terms of underwriting really remains pretty conservative, 1-3 types of debt service coverages with debt yields averaging about 10%. Underwriting remains really cautious still, and we suspect it will continue to remain cautious. Debt and equity providers remain focused on quality and consistency of income stream, which is certainly what they should at this point in time. They're looking at stability of occupancy. They're looking at major tenant events. When we have major tenant events, we're certainly looking at structuring tenant reserves and moving through that market pretty aggressively and structuring pretty aggressively for any potential downside risk. The capital market is really adequately served today along the entire stack, and the reality is there's a lot more lenders in the marketplace than there have been even 6 months ago. And we've seen a resurgence of interest in the office industrial market as property fundamentals have certainly increased. Life companies have had a great year last year. They've set new higher allocations. As a matter of fact, they're more concerned about finding enough property in the marketplace than having enough money to put out. Local and regional commercial banks have been very active over the last 6 months. We're starting to see the major money center makes move back into the marketplace, which we see as a very positive. And CMBS, while it's had sort of a disappointing first quarter, issuing about $6 billion, it has started to show some life, and we'll talk about that in a little bit. Debt funds clearly have been more active in the marketplace today, allowing us to do business all along the capital stack, and we see that as a positive. So I wanted to take a look this morning at really the capital stack. We talk about the capital stack, what's happened, where we've come from, and where we are today. And obviously, when you look at the hyper years of 2006 to 2007, we really had runaway debt inflation, let's call it. Debt, we could go out and get a debt deal done at 80%. You could throw on another 15% and on structured debt on top of that, which might be mezz, it might be preferred. But clearly, you could do a deal with 5% equity in the marketplace. We even did some transactions where it was less equity than that, 2 to 3% equity. And obviously, it led to problems in the marketplace. Obviously, during 2009, 2010, we started to pull back. We did pull back. We moved into a marketplace where lenders were very conservative. 55% lending was sort of the norm. You could add another 20% of structured debt on top of that, but clearly you needed a solid 20% equity to make a deal go. And, the funny part is between the hyper days and those cool down days, the cost of debt wasn't significantly different in any one of those periods. We moved today, and obviously there has been a positive in the marketplace, as depicted by the bar on the right side. 2012 shows a more normalized market. We have 70% debt. Life companies might be a little bit underneath that, but we are clearly doing some 70% deals. We are clearly getting up to 15%, maybe even 20% in structured debt, which allows us to leverage transaction. And the debt requirement, or the equity requirement in this case, is somewhere around 10 to 15%, which we're going to say is a normalized market. It's really what we're going to see as we move through this period. Certainly for the next couple of years. We don't see any major changes there. The other thing I'm going to suggest is if you look at the rates in the right bar relative to the rates and the returns and the other two bars, we've had significant improvement in rate and returns required by structured debt providers as a positive. I wanted to take, as I said, a little bit of a look at interest rate. This is really the relationship between core inflation and the 10-year Treasury. It shows, if you look at the little graph up on the right side, or the little bar on the right side, it shows a 40-year average. Clearly, both core inflation and 10-year are significantly below the 40-year average. However, if you look at the 12-year average, which is depicted on this particular graph, obviously core inflation has moved to its average. The 10-year Treasury is significantly below that. And part of that is simply the fear factor that we have in the marketplace today. With a euro debt crisis, with a choppy economy, with a China that may be slowing down, we're seeing foreign investors, global investors, put their money into the U.S. Treasury. We're seeing our own government with subsidizing the Treasury with Operation Twist. It's certainly keeping long-term rates at historical lows, and it's a matter of time before we start to see those push out. I wanted to show you this slide because the other nature of this is year to year, we are clearly much better this year than we were last year. Same 3-month period. Obviously, a little less than 150 basis point difference between the 10-year this year and the 10-year last year. So it is an optimum time to be able to borrow debt in the marketplace, long-term fixed rate debt. And we've been doing a lot of that, and a lot of our clients have come to us to ask us to do that. With that said, and as stable as the previous charts looked, there is a real opportunity for volatility in the 10-year Treasury. This is over a short period of time. Obviously, in late January, early February, we're feeling a little bit better. We saw our employment numbers start to improve. They became fairly consistent. Europe, debt crisis sort of seemed like it was resolved, and then all of a sudden, boom, what happens? We start hearing more about the euro debt crisis. We're starting to hear a recession in Europe, what impacts it's going to have on a challenging economy here, and we saw the 10-year start to move the other way. So, we are going to have these blips as the market moves around. We're going to have these blips as we deal with global markets and a choppy U.S. economy, clearly. I wanted to show the CMBS slide because this is really important to the office industrial sector. Obviously, last year was a very disappointing year. We thought that we'd get to about 50 to 60 billion last year in new origination and issuance. We fell short of that, something around $32 billion. The first quarter of this year, we're at $6 billion, which is once again a disappointment. But we think that's primarily hangover from what happened to the credit markets last year. And in talking with most of the issuers in the marketplace, everybody's pretty aggressive right now. There's a lot going on in the marketplace. Everybody's originating a lot of debt. So we have high hopes this year to be at $40 billion to $50 billion. I think certainly by the June or July of this year, halfway through the year, we'll be at that $20 billion level. And if credit markets cooperate, we should be able to hit that $40 to $50 billion level, which, as I say earlier, is significant for us in the office industrial sector. We need that as a capital source. So where are we headed in the marketplace? Sophisticated debt and equity providers are going to be very active in the marketplace. They're feeling more confident as property fundamentals improve. Some of the things that Hessam spoke about, some of the things that Al is going to speak about in terms of improving occupancies, absorptions, those all things ring well for lenders in general, both lenders and equity players. Life companies, we've already talked about, are very active in the marketplace. They're trying to do all the high-quality product they can. They're not going to change their underwriting, however. They're going to compete with rate, which is another interesting phenomena, but they would much rather do that with a lower leverage transaction to take it off the street than throw a lot of money at a transaction. Clearly, national banks have come back in a big way. A year ago, they were not active in the marketplace. They've started to become more active for their biggest borrowers. We see them continuing that trend. CMBS, we spoke about it. It is really critical this year that we get to that $40 billion level at least. And then, of course, the debt funds are going to play a big role by providing higher leverage, whether it be through mezz or preferred equity transactions, structuring, I think that's critical for us, particularly with a lot of the debt that's maturing, that was over leveraged, whether it be 5 years ago or 10 years ago. I think that's critical for us. And then mortgage rates. We think mortgage rates really are going to be range bound. We think the 10-year should be in the 2.5 to 2.75 within the next year. We don't think that's going to happen immediately. We're going to see some blips in the marketplace, but just as we saw 6 weeks ago, we're going to see it go up. We're going to see it come down. The key is both a global issue and a domestic issue, and we're going to see a lot of ups and downs in that market. Minimum debt spreads will come in to offset some of this index widening, but not enough to offset. So we are going to see at the end of the day interest rates effective interest rates go up for you, although certainly may not be as much as a one-to-one relationship with what happens to the various indices in the marketplace. Debt and equity providers will be plentiful along the entire capital stack over the next 12 months. I think lenders are going to be more willing to work on smaller transactions in tertiary markets. We're seeing more of those done. The small, local, and regional banks have become more active in the marketplace. Life companies, as I've said earlier, are active with CMBS in the marketplace. We clearly think for the office industrial segment, there'll be plentiful debt. May not be enough debt for every transaction, but clearly it has moved in a positive direction. So with that, I'll turn the presentation back to Al. Al?
Bill, thank you. All right, let me conclude the prepared comments today by running through the landscape of the transactional environment. And let's take a look at how some of this information is influencing the flow of capital and movement of assets across the country. So let's start by taking a look at transactional volumes and the trends here. This chart is very busy, I admit, but it mentions a couple of things that I'll highlight for your benefit. Starting with, let me quantify or qualify rather. The chart refers to transactions of $5 million and above, and you see that they are price tranched out in terms of activity between 5 and 10, 10 and 20, 20 to 40, and then at 40 plus. So a couple of things are apparent. First, if you look at quarter-to-quarter transactional trends, we continue to see the broad trend of an upward movement in velocity. Office transactions are up 48% quarter over quarter over the past 12 months, industrial up 15%. In office, what is also noteworthy is this is an expanding and balanced. It is an expanding base, but balanced also across price points. In industrial, it's weighted predominantly to $20 million and below. However, that's much more a function of the cost basis for an industrial asset compared to the cost basis for an office asset. So again, I would consider the environment for transactions to be very healthy across the pricing spectrum. And I would also comment further that I get the question a lot, when will we get to a normal market? And certainly that question doesn't come up as frequently as it used to, but I would like to suggest we are very much at a normal market. These transactional levels, again, looking at the amount of transactions occurring annually and quarterly as it's broken down in this chart, these levels are comparable to 03 and in some cases 04. And I would argue that if you stripped out 05, 06, and 07, you'd be stripping out the 3-year period that was an anomaly, transactional levels that we had never seen before. 03 was a record over a 20-year period of time until 04 happened. So again, I would say that we're in a normal market, yet it is still accelerating. So whether or not we'll get back to 06, 07 levels, that's really a hard question to answer, but I don't consider it impossible at all. The capital environment for equity, the availability of debt is really fueling the market environment. So I do expect the upward trend to continue. So let's take a look at pricing just a little bit. This chart breaks down cap rates and average price per foot. I want to make a couple of comments as you maybe absorb the data on this slide. As we look at cap rates, please note or allow me to note that this is really referring to cap rates across markets. So of interest, we do not yet see the cap rate dipping to the levels that we saw back in 06 and 07 and even certainly a portion of 08. But the reason for that really gets into differentiation that we see today, and I'll point this out in some subsequent slides. I will point out, though, that best-in-class assets from a cap rate or yield expectation perspective, in my opinion, are trading not only as well as they traded in the 06-07 time frame. I actually think yield expectations are lower today on assets going forward than they were back then. I think pricing is absolutely all the way back for best-in-class assets. I will finally say that the averages, you see pricing recovery on a per-foot basis in office, moving closer and closer to the 07 peak, same on industrial. I will point out that that is somewhat skewed, in my opinion, by investment dollars being biased towards the major metros, the higher grade assets. So your average price per foot is influenced by a higher overall quality of stock that is trading compared to what you might have seen back in 06 and 07, where there was a broader base of trade across the country. We've looked at this with you in probably the last 3 or 4 webcasts we've done. We think it continues to be a real illustration of why liquidity environment is good, why trade is robust. It speaks to really a couple of things, but certainly the gap between average cap rates and where the 10-year Treasury rests today is fuel for the fire. There's no question that that produces a great trading environment. The overall low interest rate environment, alternative investments, volatility of alternative investments really makes real estate look good. So really all that I would say here is we continue to have a very favorable environment for real estate transactional activity. I should also point out of interest, if you look kind of where the gaps widen, take a look at 96, 2000, 2002, 2009, and where we are today in 12 with, of course, the widest gap of all. Coincidentally, if you think about how real estate performed subsequent to those gaps, opening up to this degree, it performed very well. So arguably, we're also at a pretty good time in the cycle for investment as well. This is a slide that really speaks to a couple of things, in my opinion. One goes back to that normal market again. You'll notice, especially if you look back into earlier years, take a look into 04 and 05 and 06 especially, and how very tight the cap rate differential was. These were years where we had heightened trading activity, but the gap, the yield demand on the part of investors for markets, whether it be primary, secondary, tertiary, was very thin. In office, you were looking at a 50 to 75 basis point gap between primary and tertiary markets. Very little differentiation or if you will, the attributing of risk to the different markets. We see it much differently today. We see it now opened up at about 190 basis points. On the industrial side, we've gone from, in those earlier years on the graph that I referenced before, we've gone from a 40 basis point gap between primary and tertiary, and that's opened up to where we are today to 150. I would consider this more normal. This is differentiation, discernment on the part of investors for the trade-offs between risk and return between the different markets. The last thing that I'll point out also while we have this graph up is that you do see now, finally, the data suggesting what candidly we thought was going to happen even before it has now started to occur, and that is capital starting to extend on the risk spectrum, or at least the perceived risk spectrum, and move out into the tertiary market. So you're starting to see some dip down of the cap rate levels there. And anecdotally, I would simply say that continues as one would expect. Equity is starting to look at solutions outside of just those core markets in search of maybe a little bit of a boosted yield. I expect that trend to continue. Okay, taking a look now at absorption levels compared to trade. Now, right now you just have the snapshot on absorption. So this is interesting by itself. So let me point out, we do see different behavior in the market. So it is not across all markets that all things are created equal. Although I'll comment in a minute about a couple of lagging markets that have been lagging markets, that is to say. But the top 10 metros are really driving the day. On the office side of the ledger, you see the top 10 metros responsible for nearly 50% of all absorption nationally. When you take a look at the industrial side of the ledger, you have that being 2/3 of all absorption nationally. So it's no secret, really, why the capital is driving to these markets. I would argue there's a logic to the market. The market is aligning itself with fundamental recovery, fundamental strength, and where the equity wants to make a move, at least on a less risky basis. But you also see in this particular graphic, you do notice that some of the laggers are starting to move. A few markets that we haven't seen much in the way of performance over the past 24 months are starting to show up. You see on the office side, Atlanta, Chicago, and Phoenix. These are new entries to, if you will, the positive comments that we might make about markets and their fundamental performance. And on the industrial side, you see some movement from Detroit and again, Atlanta. So there is some shift taking place in the marketplace. Now, with this next slide, we're starting to align the fundamentals, in this case defined as positive absorption, with trading volume, and I think you see some very important and interesting correlations. I won't take the time right now to go through each market, and certainly maybe some of your questions will take us back to these, but let me point out that the market leaders in terms of absorption are also, for the most part, showing up as market leaders on dollar volume. Now, there are obviously some exceptions, but I'll point out that 10 of the 15 markets on the left side of the graph are on the right side of the graph. In other words, that alignment between performance, operating performance, and trade. If we take a look at the industrial side of the ledger, it's even more pronounced. 8 markets on the left are also, all of those 8 markets are on the right. So again, really the message that I'm capturing from this data would be a certain logic that exists in the market, and that correlates back to some of the previous slides as well, namely the differentiation slide, as you see the continued existence of a pretty wide gap in pricing between the primary markets, secondaries, and then on to tertiaries. So I would say there's actually a lot of logic in the market, and I only point that out, and we may get to this in the questions as I wrap up my comments and we get into those, is the market is reflecting a certain degree of logic, a certain degree of discernment that does differentiate market trading activity considerably from where we were in the 05, 06, 07 time frame. So with that, my comments are concluded, and I want to give us the opportunity now to address the questions that you have as an audience. And Hessam, I think you've been taking those in, so we'll see what you have on the list.
Right, great. The first question really applies to the two of you, and that has to do with several investors on the broadcast that want to know your perspective on distressed properties, to the degree, Al, on the investment side, that distress is still somewhat of a factor. We all know that lenders' strategy to extend and modify loans and sort of weather the storm has been the predominant theme. But our clients want to know your perspective on to the degree in which distressed properties are still a factor in the marketplace. And then, Bill, in terms of lenders, the question has come up from a few of our participants as to whether that strategy of modifying, extending, and so on will keep going. So why don't we start with you, Al?
Sure. You know, the distressed question really remains puzzling, I think, to a lot of people, including in our own debates. I think we could engage in that a lot. So I will say that I do spend an awful lot of time with the lending community, particularly in the workout departments, and it does differ a little bit between special servicers and banks. It does differ a lot between healthy balance sheet banks and those that may not be as healthy. But I will say there will continue to be distress in the market. It seems to be, and I expect it to continue to be, managed distress. In other words, no major dumping of properties on the market. There's just this gradual trickle, it feels like. And let me explain why it feels like a trickle. Because it's really a small balance business. Very rarely are you seeing A-grade property, sizable A-grade property in bulk moving in the marketplace. That's where you tend to see the workouts occurring much more readily. We see a lot of tertiary market, low occupancy, small balance. What I mean by small balance, we're talking about loans below $5 million. We're talking, in many cases, we're talking about loans that are below $2 million. So to the equity funds that are looking to place capital in bulk, it just continues to feel like it never shows up. And a lot of them have reoriented their programs to workout dollars, rescue dollars, recapitalization dollars for assets that don't actually come onto the market to trade. So again, we continue to see a boost in volume. We certainly have loan maturities that are expanding, but it's a factor in the market, does not appear to impact pricing in the market. In other words, investors are not sitting back saying, I'm going to wait for distressed pricing. So it doesn't seem to have a pricing impact on the market.
Right. Great segue to the maturities, Bill, and how that may affect lender strategy. Are we going to see more of the same?
Well, I mean, I think part of the answer is the fact that we have just improving property fundamentals that are helping things. Without improving property fundamentals, without an improving economy, we'd certainly have a bigger issue than what we have. But maturities are a big part of the game today. As a matter of fact, everyone has been watching a bulk of 5-year CMBS loans that are mature this year. There's about $20 billion of that's to mature 5 years ago. They were originated in the heyday of the marketplace. What happens with those? They're clearly over-leveraged. And so far this first quarter, about $9 billion of that has come to maturity. 48% of that, as I recall, was paid off. Another 80% of that was, or refinanced, 80% of that was paid off with no loss, and about 20% of it was paid off with some loss. Yeah. The remaining 52% of that they're working through, and there's about a quarter of that that's been foreclosed upon. Some of it is actually current, so it's not really in the negative numbers, and they're letting that run. And then there's certainly some properties that they're working through and about ready to foreclose. But as Al said, lenders, it's a managed process for lenders. Lenders feel confident about the marketplace. Time right now helps deals in that way, and there's a lot of products still to come onto the marketplace with maturities. But the other advantage in the marketplace now with highly leveraged structured products, mezz products, preferred equity products, we have more tools that allow us to save those deals and to refinance those deals. And even over the last 6 months, the number of players in that arena has improved substantially. So I think we're in much better shape. I think it's going to help the trickle of product into the marketplace. But we've never thought there was going to be just an absolute wholesale dumping of that product in the market.
Great. Thanks. I'll move on to the next question, which is directed to you, Al. And one of our participants asks if the pricing for the upper end of the market, or Class A, as you suggested, being one of the reasons that the averages are more moving up, are they too frothy? And given the conservative nature of leasing activity, given the continued focus by companies to lower costs and have more space efficiency, which is keeping absorption somewhat muted, of course, are the rent growth expectations that seem to go along with the lower cap rates and the buyer competition for the best quality assets in the best metros may be overdone?
Great question. It's also a very complex question, as you know. I don't really think it's overdone. I'll tell you why. First, bear in mind, the cap rate is a poor barometer for valuations, especially for best-in-class assets, because typically what you're looking at doing is you're looking at modeling, maybe too aggressively, but you're looking at modeling some rental growth factors and trying to foresee how this building may perform over time. So in the process, the cap rate on the front end is really just a result of the other math of the transaction. So if you're looking at, let's just take a best-in-class asset. If somebody is looking for an unleveraged yield, let's say between 6.5 and 7, arguably that's a pretty competitive yield in the landscape of other low-risk investments. Now, some might argue that office is not low risk, and that's because of the turnover costs and what have you. But I happen to believe that if you look at the cost basis on these assets today, still well below where properties were acquired in the 05 to 07 time frame. If you look at, as you pointed out, Hessam, I mean nothing going on, at least statistically, nothing going on the supply side. And as you also pointed out, although maybe not as robust as we would like it to be, clearly a number of aspects about the economy that are very positive. You combine the economic recovery with nothing happening on the supply side, and I just happen to believe that that's an ingredient for some pretty good pretty good movement, especially when the going-in yield is highly competitive with the alternatives that are there. So I don't think it's frothy. I don't think it's frothy on that basis.
And I think one of the things that should also be said is the opportunity to lock in interest rates before there is a move.
So, Hessam, I'm not going to let you get off the hook here. And I think we ought to fire the gun at you. Yeah, fire the gun at you. You know, obviously, we have a lot of positives to the economy right now. We have generally improving employment. It has been getting better, although last month the numbers weren't particularly great. We have better manufacturing numbers, and just things are more positive. But we're still sort of bumping along. I call it a choppy economy. So now we're moving into the summer lulls. We've got an election year. It's a unique year. You know, how's that going to play out for us in 3 months, 6 months, with everything that's going on?
Sure. Great question. And in fact, several questions like that have come in from the audience as well, Bill. It's a matter of a number of things holding us back from what would be a naturally better recovery. That's the bottom line. You have uncertainty that shows up in the way that companies are expanding, companies are choosing to add workers or not. For example, if you look at the several months prior to the debt downgrade last year, when there was a lot of talk about the European debt crisis causing a recession in Europe, which in many ways has materialized, and what may happen in the U.S., corporate profits kept going up, but investment by companies in capital, in equipment, actually started to flatten out and then start to decline. So despite very healthy corporate profits, corporate sentiment can move very quickly, and companies can go on the sideline very quickly. So it's not a surprise for us to have months where the job numbers all of a sudden appear to have lost steam. So I think we're saddled with this ongoing drag on what would be a much more exciting natural recovery. But I think we're in a modest recovery that should survive all this. The election year is an important factor only because, once again, another factor of uncertainty. What will come out of Washington going into 2013 and beyond? Are we going to see much more of a cooperative, stimulating in the right way, kind of a set of policies coming out, yet showing fiscal discipline to avoid another downgrade? What happens if we have another downgrade, if we don't get our act together? So it's a very fine balance. I think the economy has its own rhythm and beats, no matter what's happening in Washington. And I think if you look at all the indicators I talked about, there is a natural recovery that's moving ahead despite all these factors. But we're still very vulnerable to risks and turbulations.
So if we have risk, and I'm going to pose this to you, Al, we have risks, and certainly there's a certain amount of interest rate risk in the marketplace, and we saw how the Treasury could jump up over some news in the marketplace. If there's an easing of the European debt crisis, if this economy starts to grow some additional growth, we could see interest rates start to move up. And unfortunately, interest rates tend to move up rather rapidly, come down rather slowly. So let's say we get a 50 basis points, maybe 100 basis points increase in rates. What happens to cap rates, and is it equal from property to property? In other words, obviously the best of class assets are trading at very high levels, very low cap rates. Are they more prone to have risk for widening than maybe less than best of class assets and maybe smaller markets whose cap rates currently are higher? What happens, and do you have a feel for maybe where the line is before we start seeing things move the other way, cap rates maybe go back up?
Very good question, obviously. Here's really the number of factors here. First off, nothing's going to happen until the interest rate environment proves to be sustainable one direction or the other. In other words, when we see the spread between cap rates and the 10-year open up to where we are today, if everybody believed that the 10-year Treasury, okay, we're safe now, it's going to be sub 2% for as far as the eye can see, cap rates will be aggressively coming down. But that's not the behavior that we tend to see. If the 10-year moves up 50 basis points, which it appears that kind of volatility exists from what we've seen over the past month and a half, it's going to have to prove, if you will, that it's staying in that direction. So in the short term, I think there's very little chance of much move. What's short term? At least 6 months to a year. I think minimal chance that we're going to see pricing impact based on interest rates. I'd also throw it back to you a little bit. Shouldn't the interest rates, the borrowing rates, really be lower today? Or I'm not saying the lenders aren't entitled to their spreads, aren't entitled to their profit, but my point is I think there's some margin built into the lending rates that can absorb a degree of this and not disrupt the market too terribly. So the last part of your question, I think, was where is the greater sensitivity? Certainly the attraction to the primary markets, the attraction to the best-in-class assets is the safety associated, the feeling of liquidity. I think one of the biggest drivers of investment is, what is my liquidity? Can I get out? Because what we learned during the downturn is that it's very challenging to get out of certain positions. And that challenge is mitigated by strength of market, quality of asset. Yet, those assets are being chased so hard that a sustained movement in rates will probably force a little bit of movement in the yield expectation a little bit more quickly than obviously where the yield's been there but the market hasn't gone. One could argue that the rise in rates is coupled with a broader improvement, sustained improvement in the economy, which maybe allows some of those secondary, tertiary markets and B-grade assets to start to see some real movement as well. So, again, to come back to the beginning, I don't think there's great room for interest rates to move pricing, at least over the next 6 to 12 months.
We've already been challenged by a couple of participants in our discussion regarding the economy and interest rates. So let me address a couple of questions that just came in.
Great.
One is one of our participants is challenging the notion that we could still keep adding jobs at a time when there's all these uncertainties, and if corporate sentiment is so fragile, could we see job losses, or could we see a flattening of jobs if things don't improve much? And probably the most important factor that I see in why I think job growth will continue is that the trend that we've seen in that in 2010, over 30% of all jobs being created were temporary jobs. And by 2011, that fell to less than 8%. So, and if you look at worker productivity, companies have pushed the absolute maximum from their existing workforce. And so those two very, very important indicators tell us that basically companies need workers in order to keep going. But then it also ties to a question regarding interest rates. If we are in this uncertain environment, what would cause a movement of capital out of safety, the 10-year Treasury, which, by the way, even post-downgrade still remained or became even more of a safe haven globally in a very, very uncertain world. What is going to drive interest rates much higher related to the reduction of the fear factor in the marketplace and having capital come out of safety?
You know, I think it's we're in we have a confidence crisis, actually. I mean, I think it's a lack of confidence in the general global marketplace, and so many issues taking place today with a choppy domestic economy, uncertainty there. We have a uncertainty in Europe. China's economy looks like it's starting to slow, although the GDP is still pretty good in terms of what our standards are at 2%. Theirs looks pretty good. I think it's just this uncertainty in the marketplace. It is amazing how sentiments change pretty rapidly. And we saw that starting to change with a few months of positive job growth. We saw that change with some few positive indices on the U.S. economy. And the fact that we just didn't hear as much about the euro debt crisis, all of a sudden we saw that run up in 10-year treasuries. So it really doesn't take a whole lot to make that happen. And that's the fear in the marketplace. That's my concern in the marketplace, that when it does go, it could go relatively quickly, although I just don't see enough confidence in the marketplace. I don't see enough stability in the marketplace to allow that to happen, because just as we might get a good employment number here, we are just as likely to see some debt issue over in Europe that offsets that. And it's sort of a punch-counterpunch situation that's going on. So I think we're in this marketplace of some a little bit of erratic movements, but not huge erratic movements, and that's why I stick to my guns, which I think you agree with, right. That we've got, 225, 250 as a 10-year within the next 12 months.
Yeah, Hessam, can I interrupt? I want to shoot a question at you.
Yeah.
I think my viewpoints today have been generally optimistic. I really am leaning on the supply side of the equation as far as real estate, and coupled with a belief that the economic recovery, albeit slower still, maybe than we would like, seems to have a number of very positive signs.
Sure.
But now let me maybe jump on this series of questions and slip to the negative side a little bit, or at least ask a question. Retail sales were a big positive in the chart that you referred to earlier, but on the negative side of the ledger, consumer confidence was dipping. Obviously, home sales are not a positive. How do we correlate the improvement in retail sales with what seem to be indicators of the opposite? What would you say there?
Sure. Great question. Great question, Al. First of all, retail sales are very bifurcated. We've seen strength at the very top, where higher income households that had pulled back during the downturn have now eased up their spending quite a bit. And then, of course, we're seeing a lot of strength at the very discount retailing, or the lower end of the marketplace, because of the fact that more and more consumers are frugal and careful, and the middle part of the bell curve is not improving nearly as much. That has a lot to do with the differences that we see among consumers, based on their income brackets or income categories. But the broad recovery, the overall big picture recovery, has been much better than expected, much more robust than expected. That has to do with jobs coming back, of course. I mean, there's a tight correlation, but wages aren't growing. I mean, even though we're adding jobs, where wages are not growing. But it also has to do with the fact that a lot of consumers that are out of home mortgages have higher discretionary income in many ways, and they've lowered their cost of housing in many ways. But to your point, part of what we have to think about and plan ahead for is what happens when housing does start to recover eventually. In 2013, probably will be the first real year of a recovery. What happens when the job numbers will continue, even at a modest pace, to start to eat into the unemployment rate, again, gradually. And we get even more strength in these fundamentals. I think that prospect of better economic performance, therefore potentially higher interest rates, is something that our client base really needs to think about in terms of interest rates not staying this low forever. We still have several hundred people on the call, so I will share one more question from the audience with you before we close. Sure. And that has to do with the nature of the way that the market is bifurcated. This question is for both of you. Al, you talked about some capital beginning to move into secondary and tertiary markets. And Bill, you talked about lenders now being a little bit more willing to put debt out in secondary, tertiary markets, or perhaps lower quality properties. First of all, first part of the question to you, Bill, why? What changed in terms of lenders' sentiment from a year ago, which was still very tight? Is it less pressure from regulators? Is it that their capital positions of commercial banks, which is the main source of this kind of lending, has improved? Can you elaborate as to why that is, and is it sustainable? And now, if you can comment on, is it time to be a contrarian investor and go into these secondary and tertiary markets? Bill?
Well, the answer is clearly yes to your statements. Their balance sheets have healed. They've gained more confidence in the marketplace. You have to understand, banks are a little bit like sharks. If they don't swim, they don't live. If banks aren't lending money, they can't make money and they can't survive. So they've got to find a way to get in the marketplace. I think it's taken a while for them to understand the nature of where we are in the marketplace, what's happening with demand for these products. We're starting to see that turn around in all the numbers that you both presented in terms of occupancy, in terms of the amount of business that's being done. So it gives them confidence, and they need to move into the marketplace. We're also seeing, and we saw small banks and regional banks were a little bit fearful of moving in the marketplace. The Fed basically said, hey, we're not sure you have the capacity or the capability to be in this marketplace. It's frothy, it's uncertain, there are lots of risks. It's better for you to sit on the sidelines. I think all that's been corrected now. I think market data demonstrates that it's a time for them to reengage. They get used to their local markets. They know their local product, and it's time for them to be in the marketplace. And that's clearly what we're seeing.
Al, time to be contrarian?
Well, I don't know how much is contrarian. Obviously, the market's moved, has been biased towards the major markets. We put up some corollary slides a little bit earlier, which justified the market's moves, right? I mean, look at where the absorption is taking place, and look at where the trade dollars are happening. So, I mean, the market is making some sense based on its reaction to the markets. I will say this, however. We see expansion. We see improving markets. Some markets that we haven't had on our top list are starting to show up in terms of movement for the first time. Bill, your comments about debt, I mean, debt really fuels the market. So part of what has kept investors, particularly the private investors, I might add, and I'll comment on that in just a second, but what has kept the private investor in particular out of the secondary or mostly tertiary markets is the availability of debt. And most of these investors, although not high leveraged, are leveraged investors. So with the availability of debt improving and continuing to improve, that is fueling activity. The reason I say mostly private investors, it's not exclusive, but the reason for that is most of the institutional firms, the REITs, the pension fund advisors, are graded heavily on the markets that they're in terms of their portfolio. And if the public perceives that that portfolio may not be as well balanced as it could be for liquidity conditions in good times and bad, they can get hit, if you will, on judgment and evaluation. So that opens up an opportunity for contrarian investors to come in and enjoy a significantly better yield than they'd be forced into to compete for the few trophies that sell. So I think the trend will continue. I think the private investor will lead that charge. But we'll see a lot of expansion in those markets over the course of the year, and the debt availability will fuel it significantly.
Al, with that, I'll turn it over to you for closing remarks.
All right. Thank you. I just want to say thanks again for taking your time to join us today. We appreciate it. We appreciate especially the fact that a very large percentage of you have been on these calls with us before and continue to be on. Naturally, we welcome and are very happy to have those of you with us that are with us for the first time. As I mentioned earlier, we will be planning to get back to you with all the questions that you submitted to us today, but we're not able to get to during this live broadcast. I should also point out that what you've seen today, should you have interest in reviewing it again, it will be archived, and within 24 hours it will be available for viewing, either if you wanted to go back and refer to it again, or certainly for some individuals that weren't able to make it, this will be made available probably for at least the next 45 to 60 days. So really in closing, I just want to say thank you again, and on behalf of Bill and Hessam, we look forward to seeing you the next time. Thank you.